All right, welcome to Avery Around the Desk podcast. I am Sean Emory, founder and chief investment officer here at Avery & Company. Before we begin, a quick reminder, podcast is for informational purposes only. Nothing here discussed should be considered investment advice. Don't buy or sell anything, we're talking about, and you should look to do your own research and make decisions on your own. Investing does involve risk. Now let's get into it. Last week we spoke a little bit about that this was going to be an important week for, the AI narrative, the software narrative, those two things clashing. We got Nvidia, we got Salesforce, we got Zoom, we got Block, we got, Workday, we got Intuit. We got so many companies that I think are so important to, extract information and, continue to verify or disprove, some of the thesis that, you or I, may have as it relates to, AI and its impact across the, the software landscape and just, in the world more broadly. Now, part of the view and part of the questions is, is AI replacing software, SaaS, software as a service, or is AI really enhancing it? And, whether consumption models will kill off the seat-based models or whether, something more nuanced will emerge. And I think the more nuanced will emerge is simply how evolution tends to happen versus, linear thinking, which I think, most people in the markets and, or, people contemplating what's happening in AI, I think they're extrapolating, ideas into the future. You've had many of these various articles come out on X, whether it's, the Citrinia report or the report, the article, a couple weeks back that kind of suggested doomsday. And, some are coming back with, hey, that's science fiction. And, we have our own view. Look, we think at the end of the day, like, there's companies out there in the software space or even in the non-software space that if you're doing something that is very singular, something that is, somewhat of a point solution, you may be at risk, right? So you're really looking for durable platform companies that have multiple modules, that have, context that can't be replicated, proprietary, information in there that, isn't going to want to be, exposed out to, public vendors out there and kind of stay isolated in their own ecosystem. Compliance, regulation, all that matters. And I think, that kind of gets lost in the weeds here as I understand everyone's seeing these tools, extrapolating what it could or cannot do. And I think it, reminds me a little bit of COVID. It reminds me a little bit of the NFT craze. It reminds me a lot of, different points in time where you extrapolate something into the future, such as, we're never going to go to the grocery store. Or, people are never going to live in big cities and just live remote for the rest of their lives. And many of those same concepts, I think, are coming to light as it relates to AI. Again, not to belittle AI because it's, very powerful. We use it internally here a lot. We continue to grow our usage, but we continue to grow our usage across the board in many of the things we're doing. So again, I think it's a more nuanced conversation. It's more of an enhancement than a replacement in many ways. And I'll show some of those stats today across, some of the companies as well. So let's kick it off. Like, Benioff. Benioff spoke after his earnings, CEO, founder of Salesforce. And this is what he said. Look, he doesn't see consumption-based business models overtaking seat-based models. Consumption being, you have an agent running and it goes and completes a task and they're paying for that usage versus a seat-based model where, again, you're paying, $99 a month and, whatever you do, it's $99 a month. And, in one way, the CFO likes that because, you can manage your cost structure better when you have a fixed-based pricing. On the consumption side, it's more value add. You're paying for value. So I think companies like that from a return on investment standpoint, but they don't like that on a consumption standpoint because it can impact your line items pretty drastically. So having guardrails in place for consumption, I think, will matter. But back to Benioff, I don't know which Anthropic product you're using. This is his quote, but the one I'm using is seat-based. I don't know which OpenAI product you're using, but mine is seat-based. Same thing for us. This is about humans and agents. Humans are seats, and then we have agents too. They're using APIs, and APIs are just ways for two systems essentially to communicate to each other, and that's how agents will communicate. It's still humans and agents working together. This is continuing the quote. That is, what is exciting about the future of enterprise software? That's how I see it unfolding. It's about a world where there are apps and agents, where LLMs extend our capability. They make us better, stronger, and give us the ability to do more. Seats still exist. Consumption exists. So look, I tend to agree with that. He's clearly runs and operates a software business, so you could say he's more biased. But look, their agentic force or agent force, which is their offering as it relates to agents, is growing at $800 million revenue run rate business, growing 200% year over year. So they're seeing real traction there. Obviously, that's a small part of their large business. But then they articulated that they're seeing their seat count actually increase. So again, they're seeing their seat count increase while their agentic platform is growing pretty rapidly. So there's more to talk about there. The next page, is really Benioff articulating, look, Salesforce didn't hire any engineers or service agents here in the last year. But they increased the number of sales hires by 20% because the company has more demand than ever. So again, I think with AI, what you're seeing is where there's a place for, where you're seeing more productivity, you're going to lean into. Where you're seeing less productivity, or you were already bloated because you over invested, in that COVID timeframe, which I think should not be lost in this discussion around, AI and jobs. A lot of jobs were added during COVID, again, with the idea that everything was going to be digital. And therefore, you see a lot of digital companies retrenching a little bit in terms of jobs. But I think it's more of a function of normalization and efficiency, something we saw Meta and some others do, back in 2022, 2023. And you're seeing that a little bit with some others, that have, stayed bloated. So again, trying to highlight how there's a little bit more nuance to that as well. Continuing on, I think, one important data point here is really around job openings. We highlighted just software developers last week, but when we look at the top 10 list of Indeed's job postings, of job openings, what companies are looking for, I found it pretty shocking when you looked at the number one growing 12% essentially year over year is software development. So that's the fastest growing job openings category. It was perceived to be that, AI was going to eat software development because that's essentially one of the best use cases today. You're also seeing customer service, another good use case for AI where you can have chatbots, essentially handle, many of your customer service. But you're seeing 7.5% growth there. Sales, human resources, therapy, all these things that, a lot have claimed to be AI risk. We're in year 3.5. Obviously, every year AI is progressing, but, this is as of this past month. So again, it's somewhat of a narrative breaker as it relates to jobs and AI roles. Here's a good, interesting thing. Again, a little bit of back and forth here, but this is Jason Lemkin from SaaStr. They run one of the bigger software conferences out there. And he said, they have a small team. I think it was 12. We cut our Salesforce seats in half, but we use so much Salesforce data and agent force. Net, we're spending 50 to 60% more on Salesforce. And it's worth it. That's his quote. So again, you're seeing it. You're seeing where there's a view that software can be, taken out. First off, Anthropic and OpenAI both use Slack. They both use Salesforce. So that is not necessarily, that should tell you a lot of things. But then you have something like this where, again, let's say you had a sales rep and that sales rep has, is sending out leads. And all of a sudden you can have an agent do that. And you're winning deals. And that agent, that historical human, you are paying $200,000. And you can pay $20,000 to Salesforce instead of $99 a month. You can pay $20,000 for that, various agents. This is what Jason's talking about, where consumption can totally over consume, essentially the previous model that someone like Salesforce was running. So you want to own these platforms that have multiple modules that actually have real value, that have personal information, proprietary information that AI is enhancing. Jason, he got brought on the earnings call for Salesforce, and he says he thinks, the Salesforce model could be 3x the level of revenue because of the value that can be extracted using agents. So there's a little bit of that. Now, again, we talked about last week's software and what can help assist there. And we talked about buybacks, and obviously a lot of the big software companies hadn't reported yet. So you got Salesforce and Workday, this week, and Salesforce announced a bazooka buyback of $50 billion, which again, this is obviously a confidence from the team there, but also, it can act as a level of support in that ecosystem from a investment perspective. Workday. So what did they talk about this week? I think they're running fine. The business is doing well. We don't invest in it or anything, but we're tracking it for the sake of a lot of things, but mostly for trying to understand how AI potentially is impacting and just getting any anecdotes that we can use. And here's a couple quotes. By the way, quote, everyone of these AI leaders actually runs Workday. Just for what it's worth, Anthropic, Google, and OpenAI all run Workday. That's one. And then later in the conversation, it was, with over 11,500 global customers, expansions, customers expanding with them, our largest growth engine. In the quarter, we expanded with customers like Anthropic. So Anthropic this last quarter expanded their usage with Workday, a software platform. So again, some of these narratives of very linearly that, you can create your own software that, Workday, Salesforce, Zoom, whatever, you name it, all the software stacks are just going to be vibe coded. It's not really showing up with AI labs expanding their usage, AI labs using these platforms. It's somewhat of a narrative breaker. And then you take the jobs angle where software development is the fastest growing openings, and then customer support as well. So again, something to think about there from that standpoint. Now, the macro side, just bringing up Trueflation, real-time inflation here, it's running around 1.4%. You can see how it's continued to fall, and that is good news for that front. On top of that, we got PPI today. So this is Friday, the 27th. We got PPI today. The super core PPI year over year, you actually came down, and that aligns pretty closely to core PCE, which is what the Fed uses. And you can just see here, if you're watching this, the chart between the two, and they correlate really well. And then the PPI report leads the PCE report, and that ticked down year over year. So we're not seeing inflation reacceleration. We think that reduces pressure on the Fed to do anything that is hawkish, let's say, and I think that's a good thing. On interesting, we got somebody that I know well on on the technical analysis side. We're seeing Nasdaq buy signals expand here. Just look at how you're seeing MACD buy signals expand, which is somewhat counter to, again, some of the narrative. So again, underneath the surface, I think you're starting to see some of the companies in the tech sector start to expand in terms of some of these buy signals. We haven't seen this level of buy signals in quite some time. You saw it at the end of November, and that was about it. Before that, it was still below these levels. So I think, again, very important. Now, bringing up the stuff we've been talking about, some of these market signals, really around software. We got, I believe, another signal this week, and you're starting to see some of these signals cluster. The last time we saw clustering like this was around 2020. Again, that doesn't guarantee that anything is a bottom of sorts, but I think it does acknowledge that we are in a washed up setup, and that these things don't happen in isolation, and usually nears somewhat inflection points. So you take the prior chart plus this chart, I think it starts to get, again, interesting, like we've been discussing. Nvidia had a strong report. I think people are starting to think about competition. I think people are starting to think about some of the supply chain constraints, and being able to deliver what you want to deliver to meet some of buy side expectations. Buy side being buy side firms that buy and sell securities. So look, their business is humming along. Clearly, their data center business is growing 75% roughly. There's no visible slowdown. The thing is, and I was on Bloomberg here today, actually, and one thing about Nvidia is Jensen has thrown out the number of $500 billion. There's no update to that number. So if you're very, very bullish on AI, that's kind of your bogey. So you're underwriting to that, and therefore, if that happens, great. but are there any indicators short term that signal that we're going to go beyond that? And that's hard to justify, right? So like, when you see AMD, continuing to expand its partnerships, continue to have products that people are starting to resonate with, whether it's with Meta, making a deal with them, Nutanix making a deal with them, which was pretty cool to see given that we have owned Nutanix. And so, I think there's some question marks there as the durability and or just air pocket. And, investors, I think long-term investors, don't really care. But you again, you have a lot of trading activity that happens at the markets these days that are trying to time, every cycle. So I think that's a little bit of the rationale of why, someone like Nvidia has been not as popular here in the last year from an investment perspective. And, some then, try to triangulate that to, bubble this, bubble that. And, here's a cool chart by, in general, Phil Rosen that I, saw. And, looking at the valuation discrepancies between, the 2000s, Cisco traded at 130 times earnings, Oracle at 120, Microsoft at 60, Intel at 47. And today it's Google at 26, Nvidia at 24, Apple at 30, and Microsoft at 21, 22. So far different environments and setups than that. The correlation between NASDAQ and software is basically the lowest it's ever been. Historically, these things move somewhat in tandem. And you saw that break. Obviously, it's the AI narrative, everything I just explained above. Super important. But ultimately, I think, this is going to resolve in two ways. I think the correlations will eventually come together. On one side, you could say, NASDAQ catches down, or you can say, that, software, moves higher, or they meet somewhere in the middle. Like, again, there's multiple options there. Ultimately, everything we talked about on the software side is our view on the software side, specifically public software names that are very durable, very more platform centric. These are good companies. The AI traction starting to show up. Again, it's just trying to highlight some of the different anecdotes that we see. Adobe's AI spend, this is like email receipt data and stuff. It's starting to show up in some of the data out there. So Firefly data, AI assistant data is still picking up pace. You see, Anthropic here on here, it's continuing to take share. We've talked explicitly about how Zoom has a pretty large investment today in Anthropic. So that's important from that standpoint. But Anthropic is continuing to win. They're more than half of the billings for LLMs today. And you're seeing that in other forms of data as well, the ramp up at Anthropic. Accuracy of these LLMs. So again, I'm just trying to, I came across this stat where, there's a couple different tests that these AI models take. And one of them is explicitly trying to, multimodal, multi-dimensional, topic of how accurate these models can be when they take these tests. Now, to be quite frank, like if you gave any human a test that was across all different fields, the average person would probably have a very low score. And so these AI models are probably smarter in that sense, but are they smart enough to do everything, which is essentially the AGI concept, right? And their scores are 50%. So they're still a long ways away from, being accurate on everything. So it's something to think about as, we continue to move past in this stuff. The next page shows just, the chart summarizes everything. You see a massive spike in put volumes for software. And this was a 6-day rolling. This was from last week, right? So you could just see the capitulation, the level of anxiety, the amount of angst to, get out and or just buy puts. And again, these are things you see closer to bottoms, not tops. Revisiting the path to calm that we posted, maybe 2 or 3 weeks ago. And we labeled out like 7 things that we thought were important potential paths to calm the markets, specifically on, the AI disruption fears. Number 1 was CapEx growth moderates. And like, we haven't explicitly heard any of that. There's some anecdotes of it. But ultimately, I think, if someone like a Microsoft stock continues to get hit because they're spending too much, and that's the market's perception, the company's going to react. And they don't react by detracting their spend, but more by slowing it down. So you get a deceleration. And that would be fuel for, a market, transformation there. Valuations reset. Obviously, we've seen that. Position washed out. I just showed the put volume. I showed some of the other indicators that highlight how positions have been fairly washed out. We know funds are essentially, neutral to negative. Integration. So this week with the software names, we saw a lot of integration where, again, someone like Zoom saw 10 of its top 10 largest deals incorporate a paid AI seat. You saw Salesforce's Agentforce, accelerate to 200% growth on an $800 million revenue base. So still small, but growing fast. And so there's a lot of good things that we're seeing that show that they're showing up in the earnings. Last couple is buyback. So again, we heard buyback announcements from pretty much all the big players out there. And then last, there's two more, but I think more importantly is the security fears, cybersecurity. So Google wrote a piece on shadow AI agents, just basically showing how, companies have employees and these employees are now, incorporating some of these AI tools. And you kind of have these AI agents that are shadow to the organization, extracting some of the information from the organization. That I think that proves risk to the organizations. And eventually this will have to either slow down or put guardrails around. We also saw that the head of Meta AI, head of AI safety, she was using, one of these AI tools and her emails were, essentially deleted. So again, if you have someone in that position and they're having troubles from a AI perspective, I think that is likely to continue to creep out there and show up in other organizations and therefore, again, be a risk. Anthropic made a post on, 24,000 fraudulent accounts were generated using Claude. So again, more insights there. Last couple of pages around earnings specific to, companies in our portfolio. Someone like ClearSecure, them for the airports, but they're much broader than that. They're becoming much broader than that. They're moving into more identity. So we think in the world of AI, one of the biggest issues is going to be around identity, and having an identity provider that you can trust is going to be very, very important. So they signed a deal with Mount Sinai and other hospital systems and Uber and LinkedIn to for verification purposes. And bookings went from teens to 25%. So revenue was 16% and bookings are 25%. So it speaks to the idea of a continued reacceleration. They increased their dividend by 20%. They have nearly $1 billion in cash, no debt. So very interesting and good to see there. We saw Zoom report, and 10 of their 10 largest deals again incorporated AI. 7 of their 10 deals in their ZCX division were taken from a competitor. So that should knock a little bit of the view that competition is going to take anything from Zoom. They've grown every year since COVID, and now they're displacing some of the incumbents in some of the other parts of their business segments. So Zoom Phone, Zoom Contact Center, AI Companion is starting to monetize. And then they won deals from a leading retailer, a major insurance company, and Major League Baseball, which obviously I like. 100,000 plus customers at Zoom are growing 9%. That's now 33% of total revenue. So again, they're creeping up there. And you saw bigger deals with their what's called remaining performance obligations growing double digits. So again, bigger deals are being won, and that's why you're seeing those numbers tick higher. Lastly, Block reported really good report. There's two aspects to the Block story. Number one is growth is reaccelerating here. If you're looking at the chart, you can see it. Growth, gross profit dollars, which is their version of revenue, really growing 24%, up from 18%, up from 13%, up from 9%. So 4 quarters in a row of accelerating growth. Cash App going from 9 to 13 to 24 to 33% growth. So again, very, very good underlying metrics there. There was other metrics that they shared, but again, we've been very constructive on them for a while here. Especially post our visit to their investor day in San Francisco. The other story is that efficiency. So they built they acquired Afterpay. They 4 or 5 years ago now, and that came with employees, and then Cash App and Square had 2 different operations, and I think they're trying to become more efficient. So they had a pretty big layoff that will put them in a position from a margin standpoint. Continue to accelerate that. So you have accelerating top line growth, which signals that the company is performing pretty well. Them trying to flatten their business so they can operate even faster. They have, they open sourced a product called Goose, which is kind of like their AI agent that they use internally. And clearly that's showing some benefits there. But again, I think the story there is really around normalizing, flattening the organization from some of the overhiring that they did, in prior years. And again, that's showing up in revenue numbers accelerating. And we think a lot of that's going to drop to the bottom line. And they'll reinvest some of that into the business going forward. But 59 million now, Cash App monthly active users. They added 1 million in the quarter. In terms of banking actives, which are basically the crown jewel for any digital wallet. So now they have, I think over 9 million, primary banking actives. So a lot of key indicators that suggest that business is healthy. And obviously it's unfortunate for the people that are let go. But from a business perspective, clearly they're trying to flatten it. Very similar, like I think what Meta did years ago, and be closer to the product, closer to the teams, so they can operate at even a higher pace and take 24% growth and accelerate that here in the coming years. And so all of that is good news. The last thing is, we have obviously different companies reporting next week. There's Okta and Best Buy, so we can see how many Mac Minis are being purchased, and on the employment side, or on the economy side, someone like a Target and Costco also report. We also get, Viva, which is in the software space, Box, which is, in the software space. And, Aaron Levy has been a, pretty good advocate of AI. So anyways, in closing, are we bottoming in software? We never know what's going to happen in a week, but structurally, I think, valuations, are continue to be attractive. The companies are doing well. Buybacks are starting to become active. Hiring is fairly stable. We continue to see, if you looked at the ADP, weekly reports, jobs are starting to accelerate. AI demand is showing up. That's great in these software companies. It's showing up in other places too. And ultimately it looks like, signals all across the board are starting to cluster here. And that we're not going to have like this structural decay of these, some of these software companies. Again, we're big believers in AI. A lot of companies will get disrupted. But as long as you focus on, I think, the right things, both at the company level, but then the data level, I think ultimately what you see is these companies have the opportunity to grow much faster going forward than they were. That's it. We'll be watching all the data, so we'll see you next week. It'll probably be a little bit shorter next week. So keep that in mind. Have a good one.